Hello everyone, welcome back to Market Structure Masterclass. We're going to continue our discussion on the higher time frames protocol, but this time we're going to focus on when anticipation becomes confirmation. So I want to talk about a few mindsets we must have when we're specifically looking at confirmation. A lot of people, when they have these higher time frame levels, they just execute blindly on that higher time frame level without any confirmation. But that's the wrong thing to do. What we want to do is we want to anticipate that higher time frame level is going to hold and act as resistance or support. Then we're going to jump into the intermediate time frames and look for confirmation. So anticipation is expecting something to happen. Confirmation is finding supporting statements by evidence. And that's done with market structure breaks and displacements. So if you're just entering a setup based on anticipation only, you're gambling. But if you're anticipating a level to hold, then you see confirmation of that level holding, that is a solid setup. Our setups are plentiful and repeat frequently. What you can do is you can go back into TradingView and look at the charts all the way back from the 70s and the 80s. You'll see that these setups are actually panning out the exact same as they are today. Well, it's just a lot more efficient today since it's algorithmic, it's AI based, and back then it was actually human beings. But it's just shifted into doing things more efficiently, which is even better today. That means this is going to be so much more plentiful and setups that repeat frequently. So you should never have these feelings of FOMO or fear of missing out. Always wait for that confirmation on that level you anticipate trading on. We do not execute before there is evidence in price. We know, understand, and trust prices, characteristics, and repeating phenomenon. Nothing we do is a guess. And if you're still struggling with this point, don't worry, there's still some development process you need to go through, and what you need to do is just every single day journal the daily range. Journal the daily range. Okay, so after you go through the market structure masterclass and you have a framework to view price on depending on what style of trader you are, then the real work is actually when you're going into your journals and you're marking up these charts and saving them over and over and over again. And through time, you can't rush this, but through time, you'll understand that these setups are actually plentiful and they repeat frequently. So let's talk about using our level from the long-term perspective. So this is just to quickly sum up what we've learned from the previous two videos. Okay, so this is just a quick step-by-step approach on, alright, finding the level. Okay, and then once we found the level, we can then jump into the lower time frames and look for that confirmation. But this is how you anticipate things. So the steps of anticipation are as follows. Before we can anticipate reversal at levels, we must conclude that our trading level is one of high probability. And what I mean by probability is that there's a high chance of it holding, and I'll walk you through all the steps here on what makes a high probability level again. Well, once we have that high probability trading level, from that level we can anticipate that it's going to act as parent order flow for future moves to come. So right now, I'm looking at this daily chart, and I see that there's clean highs here, okay, and I see that we've retraced in the premium, and I see that there's a breaker, okay, but that's because I have a little bit more experience. But let's just say that, you know, this chart's very unclear for me at the time. What can I do? Well, I can shift up a time frame, and I'll use the weekly chart as my long-term perspective. You can see the daily chart is here, marked D. So now we're on the weekly chart, and we can see that, okay, it's very smooth price action. It candle close every 5 days, but I can clearly see what I'm looking at right now. Okay, this gives me a better view on what levels to use, and we'll just work our way down from this point on. So when we have that long-term perspective, we just want to look at, okay, what has happened already? Okay, what is the weekly chart telling us? What has happened previously? Did any liquidity pools get taken out? Did we break any market structures? Did we have displacement when we broke that market structure? Are we retracing? Are we expanding? What's going on? What's the story behind it? So let me just walk you through this story right here. So first we have a high of November that gets taken out and pierced through. Okay. Already, we don't want to be a buyer there because that's extreme prices, right? We don't want to be a buyer when there's a breakout happening. Okay? So, understand that this is a very high time frame level because it's space and time here. Space and time, and it's a monthly high. So, the next candle after piercing that high of November, we see a quick rejection lower. Now, for the aggressive trader, that is a order block setup here. So you can see order block here with the AGG, that's just short for aggressive. An aggressive order block trader can just wait for the high to get pierced and just enter on the order block. Okay. Where's he targeting? Okay, clean lows. There's clean lows here. Okay, so we displaced down there, and check out what happened. We left a displacement. Okay, we left it very nice and balanced, and that just shows that, okay, that the high of November was actually used as something significant. Alright, because displacements on the monthly chart can only happen when there's banks and financial institutions involved. Like us regular traders, okay, we can't move for the monthly chart like this, so there has to be like some high entity out there that's really aggressively moving this down, and that shows that's a sign by these imbalances here. Okay, but imbalances with the correct narrative. So high of November just got taken out, order block just printed an aggressive one, then we displaced lower. Okay, do you understand that there's a story behind that now? Okay, so how did we close that imbalance? Well, we just broke a recent low. We closed clean below it. Well, that's a market structure break. So right now we can see, okay, that's a potential long-term high that's into place. So we trade down lower, we trade down lower. Do we want to be a seller here? No, because that's extreme in terms of cheap prices. We don't want to be breaking out shorts right here. Okay, so this was a valid sell into this imbalance, targeting sell side liquidity. But now we have another sell side liquidity pool here that can offer potential retracement. So whenever we see liquidity pools can either offer a reversal or it can offer a retracement. Okay, retracements happened when it's counter that in the initial direction it wants to go. Okay, so it takes that liquidity pool and then it retraces, but it doesn't come for this high because this is not a reversal. Here is a reversal because of the signs we just marked out. High of November, aggressive order block, displacement, close below a low. Okay, That's why this was a valid short, targeting another sell side liquidity pool. Okay, so now we go to the same thing. Okay, sell side liquidity pool offers retracement. That's the story now. Okay, so where can it retrace into? Well, if this is the trading range from this high to this low, what are the conditions of the market? Okay, where can I find a premium? So if we're looking to be a seller because of what price just told us recently, we want to start looking for resistance levels. But we know that high probability resistance levels are ones that are found in a premium condition. So if we're looking at this order block here, you can see that once we have an order block in a discount and we're bearish, we can say that, okay, that's probably not going to hold. Okay, we want to be focusing on levels found inside of a premium. This is why it helps to make sure that you can shift up a time frame and shift down a time frame and be flexible. Be flexible because you might not realize that, okay, this could have a deeper retracement. Okay, after a market structure break, this can have a deeper, more rounded retest. So first of all, what's inside of this range? Well, there's an internal range liquidity pool that comes with these clean highs, and there's also the high of January. Okay, so that's already one reason that this can drop down lower. We just taken our liquidity pool. We know that this is a long-term high that caused a reversal. This liquidity pool can do the same exact thing. We're in the premium market. Prices are extreme because it just broke out of the high of January. That is a potential reversal. But let's look at some more factors because we want to make sure that our level is one of high probability. So we're looking at this range here. And where's the order blocks? Well, the order blocks are the most extreme part of the range as well, but it's just not the liquidity pool. So you always find like an imbalance, an order block, and then the liquidity pool. So we can see here, order blocks are the up candles before the downwards move inside the trading range. Okay, but if there's two consecutive order blocks, we can form that as one. So these up candles were used for selling, right? Because the moment price is breaking above this high, banks, financial institutions, they're selling into those extreme premium prices, which is what you want to do when you want to sell high and cover that position low. So it makes complete sense. So now we have a conservative order block. So we understand these are the two up candles before the downwards move. It's a rounded retest because we broke market structure. This is a conservative order block. This one right here, this up candle, downwards move, and the retest, that's an aggressive approach. But the conservative approach, as I discussed in the previous video, is one that's more of a rounded retest. So now we're just really reinforcing that high probability level. Okay, nothing's random here. Everything makes sense. There's logic, and that's why I love trading so much. There's an order block. We're in a premium condition. We're expecting a rounded retest, and there's an order block. So if there's liquidity and an order block, like I mentioned in the previous video, that's a high probability order block. So right now there's just so many factors that are screaming out that, okay, pay attention to this level right here. So after going through that weekly chart, we can shift back down to our daily chart, which might have been your intended time frame to look at for a long-term perspective. But now we have some more clarity on what to focus on. Okay, and now we can just blend the daily and weekly together, and then that's our long-term perspective. That's our higher time frame bias. That's what we're looking for. So now that we have more clarity from the weekly chart, the daily chart becomes easier to understand. The daily chart now prints an order block for an aggressive key level. Remember? Liquidity pool pierced. Now that candle becomes engulfed. This is a potential order block for an aggressive entry. Right? So the conservative one is waiting for a break in market structure and then having that rounded retest. An aggressive one is where you pierce a high and then you instantly retest it. So instant and rounded. That's the two defining points between aggressive and conservative. Okay, so we have an aggressive order block being printed here. This shaded area, that's the where we're looking for as a potential aggressive key level. But before we want to hunt into the lower time frames and look for confirmation, we want to find, okay, a potential draw on liquidity, so we don't get lost. The draw on liquidity acts as that magnet for price to draw towards, and tells us, really makes institutional order flow on the lower time frames a ton more easy. But to not really get lost on the lower time frames, you need to know what you're looking at on the higher time frames. So you already know that, okay, that's going to be resistance, that's going to be the short-term target. I'm just focusing on being a bearish trader within this zone here. So when it comes to finding a draw on liquidity, you want to mark out, okay, what's the present trading range at the moment? So this is the present trading range from this low to this high. And since this is around equilibrium from this low to this high, 50%, we want to be finding our draw in a discounted market, which is around here. So what's the target that jumps out at us? Well, we have an imbalance. So that's the first one. We're not going to aim for this low yet or this low, because it doesn't have to do that. We're just going to play it step by step. Because by the time price reaches this point here, that's going to take multiple days or even weeks. So there's no need to be rushing. Okay, it's going to go here, 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 all the way to the left, get a level from 5 years ago. You don't have to do that. Just focus on, okay, what's the present trading range here? What's the present trading range? What's the internal range liquidity target? That's going to be my first target. If it breaks, then I target this low. Now if this low breaks, then I target the next low. Just doing it step by step by step by step. So once price trades into our key level, we anticipate it to act as parent order flow for the move downwards. Okay. So when there's a green candle and we're bearish, we want to be selling into that, because we know that from the previous episode, with bearish institutional order flow, up candles like this produce downwards moves. So we want to anticipate that happening when this up candle is trading up, and we're going to expect it to create a downwards move based on all our factors we've outlined here. Okay, so once you've outlined all these factors, this part becomes a little bit more comfortable. Maybe if you're completely brand new, selling into a bullish move, especially when it's pumping, that might have been a bit uncomfortable. But now that you're viewing price from an interbank perspective, you're gonna have to be comfortable doing the opposite of what a lot of people say. And that's why it's best not to be in Discords or Twitter or just looking at other people's charts, because what you're gonna be doing is you're gonna be considering their perspective. But this is a one-man army, a one-girl army. So you just want to be focusing on your trades only, okay? So we got that move, and you can see that every up candle provided selling opportunity. So up candles provide selling opportunities. But what happened here? So this is what you want to be aware of on the higher time frames as well, on the long-term perspective. When you're at 50% of the price range, here, 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 expect or anticipate a potential seek and destroy. Okay, so what seek and destroy is, it's basically just trapping shorts here, inducing shorts here, and creating a collective pool of liquidity here to raid, liquidity purge for another drop down lower. So anticipate that there's going to be some sort of seek and destroy with bearish undertone. Why is it bearish undertone? Well, we've outlined that this is bearish, right? But if we're looking at liquidity pools and which way is it going to go now, well, now you know it's a bearish undertone, so we can be a seller above here, okay? Because liquidity pools is a resistance level as well. And not to mention, forgot to mention, but we have a liquidity pool here, and we have an order block there as well. So if you're trapped inside a consolidation and you want to know which way is the consolidation going to break out, are we going to go leg down, pause, and another leg down? Well, it all depends on the factors that you've outlined here. Now let's talk about intermediate term perspective for confirmation. Let's talk about market structure breaks. So the secret behind market structure breaks is narrative. It's not high, high, low, high, low, low. No, that's not it. The secret behind market structure breaks is narrative. What is the reason behind the market structure break? So if you fail to understand the narrative, the reason that makes a market structure break valid, you'll fall victim to false market structure breaks. Okay, so let's say you don't have any clue about narrative, and you're just saying, okay, high, low, high, low, high, oh, low, low. That's a market structure break, isn't it? Just like the textbook. Retail trader says low, low, then lower low. That's a market structure break. I'm going to go short the lower high and expect a lower low. Right? That's what the retail trader thinks. But the interbank trader understands narrative. Why is narrative bullish? Well, parent order flow, we just reacted from a bullish level, and we have displacement on the upside, so we should stick with that bias. Okay, even if price trades underneath a low, we don't view that as a market structure break. We say they're buying those sell stops, because that's an extreme discount. That's extremely cheap if it goes below a low, right? That's liquidity pool for them to collect. Then they understand, okay, if smart money is buying underneath the lows, okay, where is the inducement's liquidity? Will be right up here. Why? Well, basically, just to recap, there's people that shorted the breakout here, so they're going to place the stops above here. Also, there's people that are going to short this lower high here, so they're going to place this stop as up here as well. So smart money says, I'm going to target that area because we've just collected liquidity within a bullish narrative. So that's the target. And if there's a resistance opposing us, we expect it to break. Okay, so resistance level that are opposing bullish institutional order flow, they're going to break. And if you're wondering, okay, how did you find the narrative then? Like, how do you find the narrative? Well, we just did that very thing. All of this is narrative. This is the reason. So once we jump into this point right here, we can look for market structure break, and that's real narrative. We're not looking for a market structure break here. None of them. We're not looking for no bearish market structure breaks here, because we didn't hit anything significant yet. But the moment price takes out clean highs here, and we've printed an aggressive order block, alright, that's when we can start looking for a market structure break. So here are some examples of these false market structure breaks. So understand that we haven't hit a resistance level yet, so there's no reason for a market structure break. So all these people that see these, oh, lower low, I'm gonna short the resistance level for lower low. You're falling victim. This lower low is a deuce message to trap people. That's the intended move. Even if you follow the strategy of this taking out a high here prior to 8:30, lower low, the fair value gap, I'm taking that short and I'm going to target this low here. Yes, the pattern works. The pattern absolutely works, but it has to align with what you found on the daily chart. Otherwise, it's never going to work. Same thing here. 8:30, that might have been SMT. So you slow market structure break. I'm gonna short this order block here with the fair value gap, put my stop above here, and the price just reverses on you. When that happens, take the stop out, because sometimes you might be viewing the market wrong. It doesn't matter. So don't move your stop, first of all. And the next time you take a trade, try to see, okay, I took a loss, but that's a cost of business. That's price telling me more information now. So what does the daily chart look like? What does the weekly chart look like? Don't rush back into position. Just take the hit. It's like this is how you deal with losses very efficiently. When you look at like a boxer or MMA fighter and they get hit in the face, do you think they're instantly reacted to that? No, they keep their calm, they keep their cool, and they're waiting for the best high probability jabs to punch right back at them. It's the same exact thing with trading. The moment you take a stop out, don't be aggressive and jump right back in and revenge trade. Just take the hit and be non-reactive. What can you learn from the stop out? What can you improve better from it? And just move on. So here's what it's like when a stop hunt occurs, okay? So here we understand, the interbank trader understands that the narrative is bullish, and failure to understand narrative leads to false market structure breaks like this. You can capitalize on those moves with a stop hunt to order block, or stop hunt to fair value gap, right? These market structure breaks are not real market structure breaks because they didn't follow the narrative. We must frame market structure breaks from the long-term perspective. Okay, so we have a long-term perspective level here. Only then we can start looking for a market structure break for confirmation. So we're going to look for that on an intermediate term perspective. So if we hit a long-term perspective level, that's a resistance level, and then we break market structure below a low, okay, that is a valid market structure break. Okay, so let's see what a mindset of an interbank trader would seem like. Interbank trader says, I'm anticipating the narrative to switch. Why? Because we have a high time frame resistance level, a high probability one as well. A market structure break will confirm this. Low, low, low. Now, it's valid to short on the lower high for a lower low. You see? What does the retail trader think? Retail trader says, without any narrative, retail trader doesn't know there's a resistance level here. So the retail trader says, oh, we just made a higher high. They're looking for buyers here. Well, the more aware people say, oh, stop hunt here, market structure break here, I'm buying a discount here. So they put their longs here, and it just breaks. Okay, so narrative is the key here. So here, false market structure breaks. Why are they false? Because we didn't hit a higher time frame level yet. Now we hit a higher time frame level here. You can see here we have a low, breaks that low with displacement. Why is it displacement? There's a gap there. Okay, so once you have market structure breaks, what really helps is if you see gaps. Okay, so market structure break, gap at a weekly order block level. We're on the 60-minute time frame. That's a valid market structure break. So once you have that market structure break, that means the level has been confirmed. We then expect the long-term perspective level to act as bearish institutional order flow, so the parent order flow. Right, so if you go back to episode 1, okay, that's when we talked about parent order flow. Now we want to see bearish institutional order flow occur after the market structure break. So this entire red shaded area, okay, we're expecting displacements to the downside, aggressive moves to the downside with gaps, long range candles. We're expecting support levels on the left side to break, and we're expecting resistance levels on the right side to hold. Let's go into that right now. So market structure breaks. Now we're expecting support levels to break. So the first support level was this order block right here. Right, you can see that price breaks it. What about resistance levels? We can see here, gap, order block. That's a resistance level. It holds. Displacement. Aggressive moves to the downside. You can see these up candles are short-lived. And support levels are breaking. Alright. If we retrace, because we have a liquidity pool, alright. Where's the next resistance level? Up candles. Up candles will hold as resistance levels. Okay. You see here, that up candle provides new selling opportunities because it's bearish institutional order flow. What can we expect next? Displacements or gaps. Okay, gaps, order blocks, liquidity pools, all these levels on the bearish side of things will act as resistance levels, and these down candles here, or this fair value gap here, they expected to break because we've hit that weekly bearish order block. We've had that market structure break. We're expecting bearish institutional order flow to take place. So, just like I outlined in this one, displacement to the downside, support level was breaking, resistance level was holding. You can see all the resistance levels holding, all the support levels breaking, all because of this weekly bearish order block. Now let's talk about market structure shifts. So market structure shifts lead to an intraday draw. Okay, intraday draw can be an internal range liquidity pool. So from this high to this low, it could be an internal range liquidity pool or a fair value gap. But market structure shifts, the main point is it can act as that retracement to this level before we have another leg of selling off. But the market structure break is when this entire trend is going to shift to the downside. Okay, so let me repeat that. Market structure shifts are these little swings here, 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 here. There's going to be MS shift here. There's going to be NMF shift here. Alright? But market structure break is when you have that big swing to change. So whatever happened here, this is bullish institutional order flow. Once you have a market structure break, this becomes bearish institutional order flow now. Okay? So, an example is we have that weekly bearish order block. We have a previous day's low that can offer a retracement. What's the intraday draw on liquidity? Well, this aggressive order block here. Okay, so we're just going to say that's a little intraday draw on liquidity before we see another round of selling off. Why is it intraday? Well, for price to come into this level, how many candles do you think that's going to require? Is it going to require like 5 days worth of price action or weeks of price action? Or is it just going to require one up candle, then continue its downwards move? So that's why that's the short term, that's the little intraday draw on liquidity. Alright, and an MS shift is just the same thing as a market structure break, right? The same characteristics, but narrative is what matters. So MS shift, we have break of a high with imbalance there. You can take that imbalance as along. Okay, it's the same thing that happened here, but this is reacting from a weekly bearish order block from the higher time frames, long-term perspective, and this is just retracing, create that lower high here, here. This daily bearish order block was the intraday draw. MF shifts cause retracements inside the range. So here, long-term perspective level, that creates the long-term high. We'll talk more about long-term highs, long-term lows in the next episode. Here, MS shift causes that retracement for a lower high. We know that this long-term high here is going to hold unless it becomes validated. But it becomes very clear if we close above that level, then that is broken. So it's just more information across the business. But I digress. After the retracement is done here, because of the MS shift, the parent order flow continues the bearish trend. This is the parent order flow. Long-term perspective level continues the bearish trend. So like I said previously, this MF shift can cause 1 or 2 days of bullish price action, right? But the intended bearish trend due to long-term perspective level is going to continue after the retracement is done, and then you have like 4 or 5 days of bearish selling days. Okay, so understand the difference between a market structure break, MSB, and a market structure shift. You can see here, this retracement here and market structure shift is just for that lower high. Alright? But since the market structure break happened here from this weekly level, once that retracement is done, because it hit the intraday draw, the parent order flow continues trend, and you can see the displacement on the downside is aggressive. So now let's talk about market maker models. So now that we understand market structure breaks, narratives, long-term perspective, and intermediate-term perspective, it becomes a lot more easier to understand what a market maker model is. So the market maker model here is you have the original consolidation, accumulation, smart money reversal, distribution completes the market maker cell model. Okay, this is my favorite pattern. So smart money reversal is just this right here. We have a long-term perspective level hit, market structure break occurs, whatever was the bullish trend here becomes a bearish trend here. It's the exact same thing with the market maker cell model. Whatever was the bullish trend here becomes a bearish trend here, and all these support level breaks and all these resistance levels hold. Okay, the smart money reversal is identified from that long-term perspective level with the market structure break. Bearish institutional order flow on the intermediate term perspective is what happens afterwards. So we understand that there's going to be displacement on the downside, supports are going to break, resistance levels are going to hold. It's the exact same thing here, where you have distribution and distribution all the way until the market maker cell model completes, which is below an old low. Okay, so this is entire cell model here. This is what it looks like when we add long-term perspective, intermediate term perspective, we add all the supporting ideas around it. And this is what I'd like to think is the most advanced way of viewing market structure. This is a lot more advanced than just viewing higher highs, higher lows. This is understanding the complete story between market structure. So here we have that same weekly bearish order block, which is the long-term perspective level. That's going to provide the smart money reversal. Okay, here's the smart money reversal. What confirms the smart money reversal is the market structure break. You can wait for the market structure break and then short the retest. That's going to be your low risk sell. Okay, then after that, since we understand that there's going to be bearish institutional order flow on this side, every up candle becomes a selling point, or gaps becomes a selling point. Okay, but this side we're focusing directly on distribution. Okay, so we're gonna have displacements on the downside, resistance levels holding, and support levels breaking. You can see here we have support gets broken here, support here gets broken, all the way until the market maker cell model completes. So notice how all these support levels break on the downside here. Broken, broken here, broken here. But until we reach that bearish order block, this market structure break didn't make sense. Okay, so all these levels here are buying for buying. This gap here is for buying. These down candles here, bullish institutional order flow, are for buying until we hit this level right here. Then that's a smart money reversal. We're no longer looking for buys. We have a market structure break. We see that resistance levels are holding, and we're just going to be targeting all these support levels to break and then clearing out the lows. So once we now understand the market maker model, we can use the market maker model for internal range and external range liquidity exits. So we know that, okay, this side is supposed to break, but what can we target for it to break? Well, we have sell side liquidity here in a discount. We have fair value gap in a discount. We can target. And then we have the original consolidation, which is external range liquidity, and that's when the market maker cell model completes. Now let's talk about playing with institutional order flow. So once again, institutional order flow, you have to identify, is it going to be bearish or is it going to be bullish? What helps you with that is the narrative. What does the higher time frame say? Then confirmation. Here, do we have confirmation that the institutional order flow is from bullish is going to switch to bearish? Okay, confirmation is in. Now we expect all resistance levels to hold. So we're just taking shorts and shorts and shorts. You could look for longs, but just know that that's a low probability trade. So if you understand that there's a market maker model in play here, you want to stick to whatever side of the curve that's on. So if we're on this side of the curve, you can see that shorting would be a really bad idea, right? Because price is going nowhere on the downside when you try to short, and it's just a really bad idea. It's the same thing here. Okay, you could try long this up into here, but there's just no point. It's just a low probability trade. Stick to what the market maker model is telling you. So now that we understand that, okay, this entire move right here to target all these targets here is going to be bearish. Okay, bearish institutional order flow. Resistance levels are going to hold, support levels are going to break. It's just that simple. Now we can start implementing the power of 3. Okay, so once we know that smart money reversal is in, okay, and we're going to have bearish institutional on the downside here, we can mark out the daily ranges, which is midnight open to New York close, which is 16. On the hourly chart, it's supposed to be 16:30, but we'll just use this. Then, if we understand that bearish institutional order flow is bearish, we already have our daily bias. Okay, we have a daily bias. We know what we're targeting. We know when to stop targeting that, and we're just going to be selling above daily opens, looking for range expansion on the downside. Okay, here same thing, and this is how you find partials. A lot of people ask, where do I take partials? Where do I take profits? Well, narrative really helps, and market maker models really help. So you can take a partial here, 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 because you're framing it on the context of that market maker sell model we had. So that's going to be it for this episode. The action step for this episode is, I want you to frame a market maker model setup using a long-term perspective. Alright, so find a level from the long-term perspective. Make sure it's a high probability level. Then I want you to frame a potential market maker model on it. So once you have all these factors, jump into the intermediate term perspective and start looking for those institutional sponsorships. Okay, where did it shift? What support levels held a break? What resistance levels held a break? Where was the displacement going? And where is the original consolidation? Then as an additional bonus to that, what you can do is start framing out power 3. So if there's bullish institutional order flow on the market maker model, then start looking for bullish power 3 setups. And with that said, I'll catch you guys in the next video.